Coming up today, what happened this morning? Goldman thinks we drop further. A look at the most affected stocks. What will this do to inflation? Could the trade war already be over? And how I'm protecting myself from any further fallout from the tariffs. Looks like it's going to be another big week, guys. Let's have a good one. And welcome back, everybody. And as we've been forecasting, Trump is making volatility great again. Another classic Monday shakeout to start the first week of February off. The dip was bought as soon as futures opened on Sunday night, actually. Just looking at a 15-minute chart here of the E-mini. Monster gap down on Sunday night. Russell futures were briefly 4% down as soon as the market opened last night. However, that was the lowest point we saw. Dip was bought straight away, especially off the open. Same with volatility. Gapped up to over 20 to start the week. That was immediately sold off as well. And as you guys probably wouldn't be surprised by now, I was doing a little dip buying myself off the open today. As you guys know, I like to fade any spikes in fear. And stick with me today, I'll let you know where I think could be the best place to hide out from any further fallout from tariffs. And I'll share with you the stock I sold puts on later on in this video, along with my justifications for the trade. And so we were already set for a big week, being the busiest week of Q4 earnings season. Plus we got jobs report this Friday. And just to recap what happened, on Saturday, Trump announced he would impose heavy tariffs on the US's three largest trading partners. 25% on imports from Canada, for where the Canadians export the vast majority of their oil to, in which we heard a big outcry across social media on the weekend. Trudeau announced he would bite back with 25% tariffs, including beer, clothing, household appliances. Also 25% on Mexico, for which a lot of US companies get a lot of goods from, especially automakers. And a lot of food from Mexico comes into the States. Tomatoes, pineapples, avocados, quite a lot of stuff. However, just before we get into the latest news that's just hitting the wires and why a lot of these markets have actually stabilized, dips being bought, just looking at some other stocks which still finished down on the day that are still on the firing line for these tariffs. Retailers like Best Buy, automakers like General Motors and Ford, Canadian National Railway, along with Canadian Pacific, Kansas as well. And like I said, that monster dip to begin the week off because the market investors were worried these tariffs could set off a tit for tat, a full-blown global trade war, which could still actually happen, would disrupt global supply chains, raise prices for American consumers and businesses, and potentially send Mexico and Canada into recessions and very quickly. So Trump did launch a trade war in his first term in office, but this one is of much greater magnitude and a bit of a different flavor. During his first term, he imposed tariffs on about $380 billion worth of goods coming into the States, mostly from China, which Biden actually kept in place and actually ramped higher. Of course, he didn't face the same criticism that Trump's facing today. And that's because Trump's taken it to a whole new level, with tariffs potentially affecting $1.5 trillion worth of goods, not just going after China, but also close allies, Canada, and southern neighbor Mexico. The three largest trading partners from the States, totaling about 43% of their imports. Even though the States only has 5% of the world's population, the US is home to 21 out of 25 of the world's most valuable companies, and American consumers alone are responsible for over a quarter of global retail consumption. American consumer does drive global economic growth, so the US does have immense leverage over every other country. And so right now we're still in the midst of trying to work out where it's all going to land. This is obviously a big negotiation, with Trump showing he's not afraid to pull the trigger on going ahead with tariffs. And so like we've been forecasting ever since he won the election last year, we shouldn't be surprised to see some volatility in Q1 this year as the market digests this at the very minimum. If not, it could turn into a global trade war with even some small tail risks of it going further beyond that. That's why Goldman Sachs thinks we could still have a further 5% pullback in the market, which again, we can see a little softness in February. In fact, it's the worst month in a post-election year. Looking back in history and even outside election years, February can be a month where we often see a consolidation in the stock market. S&P 500 finished up 2.7% for the month of January. And so some investment banks are saying investors can protect themselves from further fallout from these tariffs with bonds. Now you got to remember the price of bonds has an inverse relationship with bond yields. So if bonds are going to appreciate, we need to see yields pull back. Typically, yields react to a mixture of things: strength in the economy, perceived forward path of interest rates from the Fed, inflation expectations. So for yields to come down, the market really needs to be certain that the Fed could maybe cut another 1 or 2 times like they're already expecting. Inflation will stay tame and the economy won't heat up too much. However, I'm not sure about all that. I think there's more upside risks than not. And yields could push higher, which would put pressure on bonds. 10-year actually dipped today. That quickly found its footing, finishing at 4.55. And the dollar, as we shouldn't be surprised, actually gapped up and is strong across the board. But we did see these big, massive reversal candles in the dollar versus Canadian dollar. Same deal with the dollar versus the peso. Similar to how stocks got really bought hard off the open. Was this just a bit of a shakeout and Trump's playing hardball as part of negotiations, knowing Mexico and Canada will come to the table as they don't want these tariffs to be a permanent thing, and that's what the market's already betting on. Saw that in a monster dip with Bitcoin, the proxy for liquidity and risk. 1 one point this morning, it was trading at 91,500. Here we are back above 100,000. Monster hammer on pretty firm volume here. Wells Fargo still thinks industrial stocks could do well despite tariffs. We just saw manufacturing come back into expansion. ISM PMI is getting above 50. That can bode well for forward returns industrial stocks, especially when they're coming out of a prolonged period of contraction. And there's Goldman Sachs tariff risk basket. Welcome to pause your video player if you want to take a further look. A lot of stocks to do with clothing, retail, automobile components, and other household goods. And these stocks are likely to stay on shaky ground for some time, as the tariffs on China could very well be dialed up, along with bringing tech stocks into the firing line, which China has some leverage over. And this is the most vulnerable sector as well, with tech stocks getting almost 60% of their revenue offshore. Materials and energy up there, the least exposed, utilities, healthcare, and financials. Financials has been one of the best performing sectors for quite a few months now. And in fact, just looking at my sector breadth table indicator, financials actually have the best long-term breadth. 89% of stocks above their 200-day moving average. Coming in second place, utilities and industrials, holding up the best when looking at long-term trends. And like I said, stick with me because I'll show you a specific sector that's actually performing well today and where I put my trade on. Could provide us some further protection of what may be around the corner, as we may not have seen the worst of tariff-related volatility. Not to mention the market getting a little spooked when it comes to inflation expectations. Tariffs definitely put upside pressure on inflation, especially if the tariff targets bite back like they all threaten to do. Mexico, Canada, China. Basically just raises prices, and that can actually reduce demand and cause a bit of a supply glut with producers. So it can potentially bring down economic growth, more so on the targets and globally, but also potentially in America as well. And this is coming at a time where the world still hasn't proven it can get inflation down below 2%, where global central banks want them. We just saw that again today with the Eurozone and their inflation coming in with a little bit of an upside surprise, 2.5% year over year, with energy costs accelerating sharply. Since Europe largely gave away nuclear, bet big on getting energy from Russia. They have much higher electricity costs than the States. Another big hurdle for good economic growth. And we can see the spread of inflation-protected treasuries versus regular treasuries actually breaking out today to a multi-year high. Like I said, we do have some upside risks here with inflation. And this could be the start of a 4-year roller coaster ride. No doubt this won't be the last time we'll see some Trump-induced volatility. So markets will remain somewhat fragile in the short term. However, like we saw this morning, there's just a wall of money ready to come in there and gobble up any dips. Selectively, that is, as we still had a bunch of stocks finishing lower today that could still be in the firing line. We are getting a little backwardation in the volatility market. VIX 9-day, a little bit above the VIX 30-day there, 19.3. But looking at other markets, bond market volatility and oil volatility, markets are relatively stable at this point in time. And just remember, volatility is the toll we pay to invest. I think of volatility as the currency we pay for performance. You can't expect to make 2, 3, 400% over a long period of time, 10, 15 years or whatever, if you're not willing to accept occasional 10, 20, even 30% corrections in the market and your portfolio. Pretty much every year we see a 10% correction. Every second year we'll see a 15%. And every 3-4 years we'll get a 20-30% or so pullback in the market. And that could be for whatever reason. Looking back over the past 120 years, wars, pandemics, embargoes, bubbles, crashes, the market's seen it all. Stocks are still the best performing asset class over the long term. And the ultra rich know that. That's why the top 1% have 61% of their wealth in stocks, which is a big contrast to the bottom 50% who have the majority of their wealth in real estate. But obviously some of that is explained by the majority of wealth being in primary residence. It's obviously going to be a larger portion in the bottom 50 than the top 1. And the fact is there's just so much money out there in the world, it does have to find a home. Think about all the pension funds, index funds, sovereign wealth funds, high net worth individuals, all of us with our pension funds and personal accounts. Like I said, we've only got a certain amount of options of where to invest our money. And so there'll always be trust issues with investing in China, understandably. There are unique risks there. Europe's so anemic with their growth, overregulation, taxation. Japan's not too bad, but there's only so much choice of things they've got to invest there. They don't really have the big global brands like America does. Not to mention how easily accessible the American market is. No financial transaction tax. A stable political and legal system for the lowest counterparty risk, not to mention the best growth. And that's why American technology stocks deserve to be higher valued than the rest of the world. And that's because they're still growing much better, in addition to all those other fundamental reasons I just said. And just looking at the 5-minute chart after hours on the SPY as I speak, we are actually rallying up here In fact, almost back at Friday's closing levels. And that's because the trade war, I wouldn't say it's over, but it could very well be on hold for a little bit here. Market having a little bit of a relief rally. And that's because a few hours ago we got news coming from Trump himself saying he just spoke with the president of Mexico, where it appears they've already agreed to Trump's request to immediately supply 10,000 Mexican soldiers on the border separating Mexico and the States. These soldiers will be specifically designated to stop the flow of fentanyl and illegal migrants into the country. They agreed to immediately pause the anticipated tariffs for 1 month, during which negotiations, headed by Rubio, Besant, and Lutnick, Trump's finance guys. So as we've been saying, it looks like for his second term, Trump's really not messing around. He's playing hardball with all these other countries, and they already look to be bending at the knee. Then after that, Trump and Trudeau jumped on the phone, as we've been hearing reports. Up to half of Canadian businesses could be planning to shift more investments and operations to the States to mitigate potential tariffs. Same deal again. Trump agreeing to pause tariffs on Canada for 30 days while they try and work out a deal, hence why the market's getting excited. And so even though the Canadian ETF got a massive buy the dip candle in the regular session, just going out a 5-minute chart after hours, we're up almost 2%, taking us to 41.38, which is actually higher than where it closed on Friday. And looking at the Mexican ETF, they already finished higher than Friday in regular trading, and it's still ticking up after hours as I speak. And some of those hardest hit sectors today, like retail, getting a little bit of a pop after hours. But hit the hardest was home builders. They import a lot of parts. Little tick up after hours, but still a bit below Friday's close there. Looks like the market already had home builders under pressure for a few months coming into this. And General Motors and Ford catching a bit after hours as I speak as well. Next up is Zelensky. Trump's expressed his desire for an agreement where Ukraine would supply rare earth elements to the States in exchange for continued aid. Currently, America relies a lot on China for these rare earth elements, which they've already expressed could be used in a trade war. So he's looking to hedge his bets here. Chinese have been making moves, pretty much take control of the Panama Canal, built by the American. Trump sent Rubio there over the weekend. Appears they've put a bit of hardball pressure on them as well, for which Panama president appears to agree to as well. So his country will not renew a trade and development agreement with China. China wants to make them part of the Belt and Road Initiative, leverage one of the most vital shipping lanes in the world. Panama also said they'll remove the fees for American ships to go through there. And it looks like he's effectively tipping back the power into the States when it comes to the Panama Canal. And he's having a busy first 2 weeks in office. Over the weekend, ordered a precision military strike on ISIS terrorists in Somalia, while sending a warning to others: we will find you and we will kill you. So I agree with Putin and what he said over the weekend. Europe will stand at the feet of the master. They pretty much don't have an option. Europe's too vulnerable when it comes to security without the help of the American. And that's because NATO, for pretty much its entire existence, has been financed largely by the American, even though it's pretty much security for the Europeans. So we should expect some news potentially this week, next week, maybe with Trump starting off with tariff threats on United Kingdom and Europe, for which we've already seen he will go ahead with unless he gets a deal done. Like I said, he's not messing around this time. And so if that's the case, that could actually be a good thing for the stock market. Even though we may see a bit of this short-term fragileness and volatility, it could very well find its footing quickly, as it may not turn into a full-blown global trade war, but rather just some quick showdowns and negotiations. Hopefully, that's what happens, as it looks like we're quickly going back to a US-led world order, with the rest of the world being forced to respect the wishes of the states. If not, they'll pay a big price. If these tariffs stuck to Canada and Mexico, huge parts of their economies are reliant on exporting to the states, could very well send them into a nasty recession, and very quickly. On top of all that, you also had time to sign an executive order calling for the creation of a sovereign wealth fund in the states. US government going to get its own hedge fund, which he's already hinted could buy TikTok. Wants Elon Musk to do something with TikTok, in addition to investing in infrastructure such as airports and highways, which is much needed throughout the country, and could also help the US extend its influence in Panama and Greenland. With US Treasury Secretary Scott Bessent saying, we're going to stand this thing up within the next 12 months. We're going to monetize the asset side of the US balance sheet for American people. There'll be a combination of liquid assets that we have in this country as we work to bring them out for the American people. So I think it's a pretty good idea to pretty much create a massive investment fund, can help finance initiatives and objectives, and potentially help create some wealth to pay down the huge amount of debt. Again, this is just more support for markets, for which we could be seeing another big investor enter the ring. And again, no surprise to see the dips get bought on any cooling worries of tariffs, as the fundamentals are still pretty good. S&P 500 is actually on track for 14% year-over-year earnings growth, and we're in the thick of Q4. 181 companies reported out of the S&P 500 so far, 79% of them beating, 5% upside on expected numbers. That's pretty good. But no doubt we're seeing a bit of volatility around the world. Looking at international country ETFs here today, Germany down 2%, and a few other European countries as well. Market probably getting nervous that they could be next. Poland down 2.6%. Funny enough, it was Brazil and Mexico actually stood up the best today when it comes to international stock markets. And just going back to the S&P 500. So no doubt Trump is proud of the stock market. Remember in his first term, used to watch it all the time and comment on it. No doubt the Trump put will always be there if the market dips enough. But I've been thinking what could be different in this second term is that maybe he doesn't mind tolerating some short-term weakness a bit more than his first term, and possibly to get things out of the way early before he could pump it for the midterms. And so maybe he doesn't mind the market pulling back over the next couple of months without having to do anything to rescue it right away. And that could actually help him achieve some of his more longer-term objectives, helping to get rates down. Fed's more likely to cut if we get a pullback in the market. Could help with inflation a little bit and get some other border trade fiscal policies out of the way early on, as no doubt he want to finish his term with the stock market higher. But if the market is pulling back, more likely to get tax cuts, more likely to get a Fed cut. But then, like I said, no doubt if we dip too hard, we'll get not only the Trump White House put, but we'll also get the Fed put. But like I said, anytime we have these dips, 5th of August, the 20th December, last Monday and this Monday, just appears to be pretty strong bids coming in there. And like I said, no doubt risks and volatility remain, especially when it comes to an inflation. And that's why I think the best performing sector out there today, and the one I said at the start of this video, I'm going to share my trade with you guys, gold miners. Finishing up 1.5% today, the only sector to finish up over 1%, with even some of the junior miners starting to wake up. I Am Gold breaking out to a new yearly high. Same deal with Equinox, and a gold stock I've owned for a while now. Alamos Gold breaking out to fresh yearly highs. And just looking at a long-term monthly spread chart of junior gold miners ETF versus the underlying commodity gold, we're still pretty much as low as we've ever been. This massive support base has been going on for almost a decade now. And so there's still plenty of room for gold miners to catch up to the underlying price of gold, which is currently sitting at all-time highs of $28.49 in a pretty persistent bull market here. And that's what prompted me to take a bullish position in one of the largest gold miners in the world, Newmont, as it's still well below highs, and I believe it represents great value here. Like I said, the potential for junior and senior miners to catch up to gold, because on some measures, like free cash flow multiples, gold miners are the cheapest we've ever seen them. Whilst, like I said, we've got gold sitting at all-time highs, and the cost to get it out of the ground, some of the cheapest as well. Looking at a long-term spread chart here of crude versus gold, again, one of the lowest we've ever seen. And so that translates into good profitability for the miners. The cost of crude is very correlated with the cost to get it out of the ground. Very energy-intensive operation. And this could very well stay low for years to come as well, thanks to huge supply of oil coming out of the States. And just looking at Newmont itself, its price to its net asset value, the gold it has access to, again, we've never seen it cheaper. Currently at 0.62, so basically buying $1 for 62 cents, of course, with some risks to that, but that's well below its long-term average of 0.98. And so all that's prompted me to increase my exposure to gold miners with Newmont. I sold the 42 strike puts expiring later this month and regular OPEX on the 21st. Happy to take delivery and actually hold this for a few months, at least till all these tariff-related storms pass by, because this is another hedge on inflation. Being a gold miner, gold price sitting at highs in a strong bull market. The ideal result for this trade would be sometime by Christmas. We trade up into the 50s, and I could maybe write a covered call somewhere in the low 50s here and keep overriding on it until the stock's called away from my account. Making money 4 times, collecting the premium from the short puts, dividends while I hold the stock, premiums from the covered calls, and of course, the difference between where the stock is put and called away from my account. Otherwise, if all these tariffs don't turn into a global trade war and it resolves itself a lot better than what we're all expecting and Newmont pulls back, well, I'm okay with that as well. As always, please do your own research. I'm just sharing with you guys a trade and my justifications behind it. And of course, anything can happen. So we'll see how this one pans out. Also interesting to see today, chip stocks did get hit pretty hard. Most of them still finished regular trading off somewhat here, including Taiwan Semi. Still don't know how China's going to retaliate and whether they can work out a deal. But it was good to see the stock that I'm also short the 20 puts on, Intel, hold up the best. And it too is actually trading back to Friday close levels after hours as I speak. Zim did have a bit of a gap down today. It's trying to defend the support zone. And like I said, we've still got other stocks that are at risk, especially from China, like Gap. Floor and Decor Holdings, also in a big support zone here. And other retailers like Stephen Madden, and alcohol companies too, Constellation Brands, still on the firing line. But hot stocks are still hot. Oklo, still monster volume ripping up here today. Healthcare AI stock, Tempus AI, doing well. And even the quantum computer trade hanging in there, INQ. And another one of my winners, Hims and Hers Health, continuing to break out here today, along with some other hot stocks. Dutch Bros, Coffee Drive-Thru, exceptionally strong. And the meme traders over on Reddit, still having a good time, holding on to its strong uptrend ever since its blowout earnings. And it's going on a 5-minute chart on SPY as I I speak, still holding onto these gains post-market. So the market does seem somewhat relieved. These tariffs with Mexico and Canada at least are going on hold for 30 days. They very well may come to the table, get a deal done quickly. Next up will be China, and we'll see what happens there. But them, along with the United Kingdom and Europe, that could all play out over the next couple of weeks. We'll just have to wait and see what happens. But like I said, there are still plenty of stocks in the firing line, especially retail, automobile, components. Market's still worried about upside risks to inflation, so it's no real surprise to see gold trade firm here, and hence a big reason, in addition to Newmont's valuation, why I've taken a bullish position in the stock. That's all for this busy Monday to get you updated. Thanks very much for sticking with Click Capital, and no doubt we're in for another interesting week. Cheers.